On Business Incorporated today, European Union Council set to approve €72 million budgets for EU security and immigration mission in Niger. An African Development Bank to receive $5 million grant from the U.S. government to tackle methane emissions. Nigeria and Morocco signed MOU on 5,600 kilometers gas pipeline project. Hello and welcome to the program. I'm Will Ibong. Let's begin as always with major equities from Africa, where sentiments were in negative territory at intraday. Nigeria's NGX was trading down 0.03%, while South Africa's JSE tumbled 1.51% at intraday. Elsewhere, Egypt EGX 30, which was closed on Thursday, was down negative as well, while the Nairobi Securities Exchange closed Thursday's trading session deeply in the red. And to the Middle East, where most major equities were closed on Thursday, except in the UAE. The Abu Dhabi and Dubai exchanges traded in opposite directions at intraday. The Abu Dhabi index was up by 0.53%, while the Dubai index fell 0.16%. Saudi Arabia and the Qatari indexes closed trading on Thursday for the week. Trade ministers in Europe for the group of seven, that's the G7 major economies, agreed on Thursday to take a harder line on trade relations with China. German Minister Robert Habeck tells reporters at the meeting in the country's north that the group's naivety in its relations with Beijing was over. Correspondent Stephen Beardsley joins me for more. Stephen, pointed words there, but what does it mean in terms of policy?
Well, what we've seen is that in recent weeks, electricity generators have actually been making more solid profits because of the price of electricity on the market. It's risen, and that's because that price is driven, in fact, largely by gas prices. And as we've known, because of the war in Ukraine, because of EU measures about importing Russian gas, and because Russia has also stopped exports to the EU, we know that the price of natural gas has risen dramatically, and that means in turn that electricity prices have risen dramatically. Now, if you're an electricity generator and you don't rely on gas, that is, you generate through coal, through nuclear, through renewable, then you're making quite a healthy profit because you're not paying for that gas. And so that's where the EU wants to come in. It wants to slough off some of that profit, and it wants to use that to help allay those costs that consumers are facing. And there are really two measures here. One is it wants to cap revenue generated from electricity at 180 euros a megawatt hour. That means the EU would take everything over that, and it says that that would still leave most generators right now with a healthy profit based on what electricity prices are doing right now. The other part is that they want to actually put a windfall tax on, I should say, a profit tax on larger fossil fuel companies. Think of oil companies, for example, that in recent months have really benefited from what we saw were sky-high oil prices at one time. They've since come down a decent amount, but there were record profits that we saw from some oil companies. So by adding a tax on them, a special tax on what they call surplus profits, and they have a special calculation for what that is, then with those two measures combined, they're looking at $140 billion in revenue that member nations will then be in charge of applying both those rules, that they will be in charge of applying that revenue from it to help their own households.
Well, Stephen, this is all very interesting, but how important is China for the G7?
Yeah, they certainly won't. I mean, there's a cost of living crisis that's looming over Europe right now, and that's because of those rising gas prices. When you look at the spot market prices for natural gas right now in Europe, about 75% higher than they were a year before, and that could, of course, rise as demand grows in the winter. So someone has to pay for that, and the utilities can only handle so much before they collapse, but they're considered structurally necessary. So some of those costs have to be passed down. And so it's not just going to be this measure that takes care of it, but national governments are putting in place other measures as well. In Germany, for example, they've increased the child allowance, for example. They've also passed a one-time energy allowance for households. And they have to take a look now at businesses and how they're going to help businesses. We're seeing more warnings that there could be an uptick in insolvencies across the country as smaller and mid-sized businesses in particular try and deal with setting aside production, for example, if they rely on natural gas. or just because they can't handle those higher electricity prices. So that's what's going to come next. Maybe some of this money from these EU measures will then be able to benefit some of the cash grants, some of the loan guarantees that we'll probably see that are intended to help businesses.
So what are we seeing from European markets today?
What we're seeing today is a definite rebound compared to what happened, the massive sell-off yesterday. We should be careful in saying that this is somewhat of a rebound, that there seems to be somewhat of a return upward, a tick upwards as investors reassess the massive sell-off from yesterday. The same thing happened in the U.S., the same thing happened in Asia. And so we're seeing that the major indexes in Frankfurt, Paris, and London all up around 0.5% on average to begin trading on Thursday. And that sort of follows what we've seen elsewhere. Investors are really trying to recalibrate and understand what's going on with this inflation environment right now, following that reading in the U.S. And then, of course, they're anticipating what's coming with the Federal Reserve. Next week, it's expected to raise interest rates probably 0.75%, hundredths of percent again, which would be significant and in line with the current inflation reading. Is what we're also seeing is that banks are among those who are actually doing well right now in European shares because they would benefit from those higher interest rates. So everything really following along the expectations for inflation and what central banks will do to respond to it.
Thanks, Steve. And now we move over to Asia, where shares in the Asia-Pacific fell Friday as investors digest U.S. economic data and China's industrial production and retail sales figures for August, which beats expectations. The Shenzhen component in mainland China briefly paired some losses after the data release, but then extended losses and closed 2.3% lower. And the Shanghai Composite was down 2.3 as well. Japan's Nikkei 225 fell 1.1%, and the Topix Index slipped 0.61% to 1,936 points. In Australia, the S&P ASX 200 dipped 1.52% to close, and South Korea's Kospi also dipped 0.79%. Hong Kong's Hang Seng Tech Index was down 0.89 in the final hour of trade. Now move over to the U.S., where stock futures fell Friday morning as Wall Street headed toward a losing week and traders absorbed an ugly earnings warning from FedEx. Dow Jones Industrial Average futures dropped by 0.79%. S&P 500 and NASDAQ 100 futures declined 0.92% and 1.15% respectively. But before we go on, let's take a quick look at yesterday's trading activity with our correspondent, Maria Bird.
The U.S. stock market closes much lower on Thursdays as investors eye the next Federal Reserve meeting. It is clear that investors are concerned that the inflation report that was released this week has cemented the interest rate hikes that are expected by the Federal Reserve very soon. The Dow Jones on Thursday was down by negative 0.55%. The S&P 500 also down by negative 1.13%. And the heavy tech NASDAQ was down by 1.42%. It is clear that the market is definitely experiencing a hit over the last few days. But investors will continue to watch to see what happens next, specifically when the Federal Reserve meets next, how this will have an impact on the U.S. economy. The stock market tried to rise up in the middle of the day on Thursday, but it just could not sustain and continue to fall. This is expected to continue through the end of the third quarter.
Thanks, Maria. Oil prices dipped in early trade on Friday, extending the week's losses as concern over tight supply was outweighed by escalating fear of sharp interest rate hikes, slamming global growth and hitting fuel demand. Brent crude futures fell 0.2%. After sliding 3.5% to a one-week low in the previous session, U.S. West Texas Intermediate crude futures lost 0.3% after tumbling 3.8% in the previous session. Both benchmarks are headed for a third consecutive weekly loss, hurt partly by a strong U.S. dollar, which makes oil more expensive for buyers using other currencies. The dollar index ticked down on Friday but held near last week's high, above 110. Now, gold prices languished near a 20-month low on Friday, heading for their worst week in 2 months as prospects of aggressive rate hikes by the U.S. Federal Reserve lifted bond yields and took the shine of bullion. Spot gold was flat at $1,633.09 per ounce after hitting its lowest since April 2020. On Thursday, prices were down 3.1% for the week so far, and spot silver dipped 0.2%, platinum fell 0.4%, while palladium was little changed at $2,135.78. Now, the United States government says it will provide a $5 million grant to the African Development Bank to support efforts to abate methane gas emission across Africa. This was made by the U.S. Special Presidential Envoy for Climate, John Kerry, at the 18th African Ministerial Conference on the Environment in Dakar, Senegal. The grant will go to the multi-donor Africa Climate Change Fund, which is managed by the African Development Bank, which supports a broad range of activities, including climate resilience and low-carbon growth. The Global Methane Pledge, launched during COP26, targets reducing emissions of methane by at least 30% from 2020 levels over the next 7 years. And now to a farm in Egypt where Delta employs the use of advanced techniques, including fully automated, data-driven and monitored greenhouses for climate change adaptation as the country braces for hosting the upcoming COP27 summit. Tolima Farms has over 20,000 square meters of data-driven polycarbonate environmental control greenhouses with a mission to build an environmentally conscious agriculture community in Egypt.
Owners of a farm in Egypt's Delta Governorate of Beira are using fully automated, data-driven and monitored greenhouses to track the health and progress of crops by the minute as the country faces the negative impacts of the global climate change crisis. The farm, named Tolima, meaning let's farm in a Bantu language, stretches over a 25,000 square meters plot of land that was once cultivated in traditional ways before owners transformed it into one using hydroponic and vertical farming techniques. The family business aims to increase yields while saving water and energy on the smallest possible plot of land. At the farm's greenhouses, alternative soil made of cocoa peat and recycled plastic containers are used to grow crops using hydroponic farming, with controlled temperature, humidity levels, as well as recycled water. According to the owners, the technology helps optimize space and increase yield compared to traditional farming techniques.
Here we are different from traditional agriculture as we use alternative soil for agriculture. We use a product called cocoa peat, which is grinded coconut pith, to grow our crops in an environment free from diseases, rot, bacteria, or any other harmful elements from the soil. We also put the plantations in bags made of recycled plastic bottles while using a closed-circle water irrigation system that helps me keep 90% of my water. In this greenhouse, I use only 10% of what could have been used in an outdoor land in order to produce 10 times more yield than the one produced by the same plot of land outside in traditional agriculture.
The farm also includes a number of vertical farming containers with controlled environment which allow crops to grow vertically, further supporting space optimization while consuming 20 liters of water weekly.
This container is a complete farm, from the seed to the harvest. Here, we plant using modern techniques, vertical farming, which enables me to grow more plants. In addition, it's very environment-friendly. It consumes around 20 liters of water weekly, and it's operated by solar panels installed on top of the container, so I can move the container anywhere in the world. Because it employs controlled agricultural methods, it can operate in the desert, in the cold, and in the snow.
Tolima's owners said the technologies employed at the farm and the pesticide-free policy save cost, helping them target more clients for their products.
People expect that the price of our products is expensive because they are pesticide-free products and planted using advanced technology. But actually, the opposite is true. Technology saves costs, and because we don't use pesticides, this is already a big cost I am saving. The technology I use allows me to produce 10 to 15 times more with the same plot and same number of workers. Therefore, the cost is less.
Tolima's technological culture penetrates the Egyptian farming sector by providing hyper-local, highly nutritious and water-responsible produce to customers.
Now, Nigeria and Morocco have signed a memorandum of understanding for the execution of a gas pipeline project that will transport natural gas from Nigeria to Morocco and onto Europe. The Nigerian National Petroleum Company Limited, NNPC, which made this known in a statement, says that the MOU was signed on Thursday in Rabat, Morocco. According to the NNPC, the Nigerian-Morocco gas pipeline is a 5,600 kilometers pipeline project crossing 13 African countries, which, when completed, will provide about 3 billion standard cubic feet of gas per day. More stories from the African continent right after the break. This is Business Incorporated. Welcome back. In Kenya, fuel prices have risen once again after the government partially removed subsidies that cushioned consumers from the global hike in oil prices. According to Kenya's energy regulator, the subsidy for super petrol had been removed while retaining a smaller subsidy for diesel and kerosene. At the new prices, super petrol, which is mostly used by private motorists, will now cost about 179 shillings, which is about $1.50 a litre, up from $1.03, while diesel, which is used by transporters and industries, will cost about $1.40 in the capital, Nairobi. But what impact will this have on businesses? Matt Kindiger, practice lead, Sub-Saharan Africa, Frontier View, joins me from London to discuss this. Hello, Matt. Good to have you again.
Hi, great to be on the show today.
Matt, why has the government slashed fuel subsidies this much when oil prices are skyrocketing so much in Africa?
Yes, that's right. So it is quite a controversial time because global oil prices and domestic fuel prices in Kenya and across Sub-Saharan Africa are quite high, especially by recent historical standards. So when we compare to oil prices when we compare oil prices to 2020 and 2021, we really have seen a significant increase. So there are a couple of reasons why we think this is happening right at this moment. So the global oil prices have come down slightly since June, and so this is probably a window of opportunity that the government is seeing to take advantage of lower oil prices to reduce the subsidy bill. But there are probably two other factors as well. One is that we had an election recently in Kenya. The election period is now past, so the new government under William Ruto now has a bit more political space to make politically difficult decisions, which are potentially quite unpopular with the electorate. For example, removing fuel subsidies or reducing fuel subsidies. So the timing is very important. And the other reason is that this illustrates the fiscal pressures that the government is facing. So there are quite significant pressures on the government's public finances at the moment. And this was likely just a decision made in order to prevent the fuel subsidy bill from spiraling out of control.
So you mentioned the public finances now. So what's the outlook for public finances? What does this mean for that?
Certainly. So yes, it really does illustrate the pressure that public finances are under at the moment. What we expect to happen over the next year or so is, because of the scale of the pressure on public finances in Kenya, Mr. Ruto's new administration will likely be forced into cutting spending and investment, or raising taxes, or a combination of all three, and tightening revenue collection. And this is because budget deficit is very large. It was estimated to be about, over 8% of GDP over the last fiscal year, and is expected to exceed 5, maybe 6% through the end of this fiscal year. So certainly very significant pressures there. The government has been forced into bailing out state-owned enterprises like Kenya Power and Kenya Airways. So certainly significant pressure there, and we are expecting not extreme austerity measures, but much less generous spending growth from the government over the next year or so. This is also very important because Mr. Ruto will need to ensure that investors have improved confidence in the government's ability to manage public finances, not least because the shilling is likely to come under significant pressure if he doesn't do that, and if the administration doesn't do that. And in the worst case scenario, we could see Kenya facing some form of debt distress as early as Q1 or Q2 next year, if there isn't significant consolidation of public finances. So really, it is quite an urgent matter for the government.
So given these recent developments in Kenya, how high do you think inflation is going to reach in the country?
Yeah, certainly. So Kenya's inflation rate has actually been relatively muted by sub-Saharan African standards and also by global standards. So we certainly have seen an acceleration to about 8% recently, but this is quite low by comparative standards across the region. However, that said, we are expecting to see inflation continue to accelerate, and it could exceed 10% year on year by the end of this year or the beginning of next year. And this is because we actually are expecting oil prices here at Frontier View to continue to rise. And so the removal of the fuel subsidy, for example, or the reduction in the fuel subsidy will then be felt when oil prices begin to rise again. We also are expecting to see global food prices rise. And in Kenya, the country is struggling with a drought in the east of the country, which is reducing food production and also raising domestic food prices. So certainly, we would expect an average inflation rate of between 8 and 10% in 2023 and probably about 6% in 2024. But certainly, we would expect to see inflation accelerate before it falls over the coming months.
Matt, inflation is really skyrocketing. Nigeria just recorded a 20.52% inflation rate yesterday, and we're still, trying to process and digest that information. Probably we'll talk about and break that down some other time. But it's always good to talk to you, Matt. Good to speak to you today.
Thanks for having me on the show.
Nice. Now, moving on to other stories, the European Union Council is set to approve a budget of 72 million euros for the EU Security and Immigration Mission in Niger. According to the EU, the mission is tasked with supporting Nigerian security actors in the fight against terrorism and organized crime, as well as the development of policies, techniques, and procedures to effectively control and fight immigration. According to the new decision, the EU Security and Immigration Mission in Niger should provide for developing an integrated, sustainable, and human rights approach among Nigerian security actors through advice, training, and mentoring activities. And that's it on Business Incorporated. Do stay with us next week for more stories from Africa. Thank you.